The only thing worse than a portfolio being hit by a 37% drawdown like we saw in April is sitting on the sidelines and watching the market rise 50%. This entire year, which many would be happy to forget, has been a master's class in psychology as a giant game of tug of war between fear and the fear of missing out has unfolded. One of the most prescient lessons has been that the economy is not the stock market and the stock market is not the economy. So even though the stock market has bounced back in a V shape, the economy is still significantly lagging pre-COVID levels. COVID-19 has disproportionately hit lower income, frontline, service-related workers, not to mention minorities, women, and single-parent families, while high-income, white-collar workers who own a disproportionate amount of equities have largely been able to adapt to work-from-home changes. Another interesting observation leading to the V-shaped bounce back in the stock market has been the surge of online day traders seeking a reprieve from the boredom of staying in and fueled by the drastic reduction in trading fees, the introduction of fractional shares, and the lack of traditional sports and gaming gambling options. But when we look back at 2020, there are a few signposts that will be at the heart of the bubble debate. Some of the most obvious signposts of euphoria include Kodak's dizzying returns, Hertz's worthless paper soaring, Tesla's race for S&P inclusion, the SPAC craze, and overall market concentrations and valuations. But euphoria has never been a good market timer. Let's look at valuations today and try and put them into a historical context. The S&P 500 is trading at a lofty 5 turns higher than its 30-year average, essentially higher than at any period outside of the technology bubble of the late 1990s. The TSX is slightly better at 2 to 3 turns higher than its long-term average, largely due to the cyclical composite of the Canadian index. But are these levels justified? Oaktree's chairman, Howard Marks, addressed this issue in a recent memo where he explicitly laid out the decomposition and outlined a great explanation of why stocks can be justified at current levels. The crux of the argument is that equity markets should trade at an earnings yield, which is just the inverse of the price to earnings ratio, close to the treasury yield or the risk-free rate, plus an equity risk premium, which is in the 3% range, for a total earnings yield of about 4%, which then translates into a price to earnings ratio close to 25 times. And that isn't even the bull case. The bull case suggests that the appropriate earnings yield should be the risk-free rate plus an equity risk premium, less some long-term growth rate, which has typically been in the 2% range. Now, this leads to a conclusion that maybe multiples can go even higher than where they are today. Over the next few quarters, while we don't know which direction the market will go, we do know that there will be lots of volatility as economies try to reopen and potentially have to revert back, plus the upcoming US election, tensions with China, and the overall economic earnings. However, we also know that over the long term, the market tends to move higher. So spending less time market timing and more time identifying quality businesses that compound returns over time is the more prudent strategy. Now, on the topic of the US election, many investors are asking what a Democratic win versus 4 more years of President Trump would mean for stocks. Based on the work I did following Trump's surprising first-term win, the conclusion I came to was that the presidency is largely uncorrelated with stock market returns. And in fact, results are often quite counterintuitive. There will likely be overreactions in specific sectors, such as technology or healthcare post-election. But those reactions are what creates investment opportunities. One meta theme that we will clearly benefit from under Biden is the renewable sector, given his communicated plans. However, the renewable theme is bigger than any one person, and the long-term investment case is strong under either candidate. Pipelines will remain contentious, and new pipelines will continue to be a challenge to install. But this likely inflates the value of existing infrastructure in place. Expenditures and debt levels are all biased higher under either candidate, which could pressure the greenback and keep a healthy bid on gold and other commodities. But no matter who wins the election, the likely biggest beneficiary over the next term is going to continue to be the Saturday Night Live comedy writers.